Hello, welcome to our latest webinar. My name is Jamal Khan. I'm a senior tax partner at the Churchill Tax Group. Today we're talking about property incorporation or transferring of properties into a limited company and property tax planning in 2024. There's quite a lot of things that we need to cover, and I will just share my slides. Here we are. So property tax planning and incorporation in 2024. Here's a little bit about us. Okay, let me see if I can share the slides. Yeah. So we're a specialist tax advisory firm, specialized in tax planning, tax advice, and tax investigations, tax litigation, onshore and offshore tax planning. I'm a specialist in property tax planning, and I advise numerous clients at different wealth levels on strategic tax planning to mitigate their inheritance tax, capital gains tax, and income tax, corporation tax. So transferring of properties into limited companies is a hot topic. A lot of people are doing this or considering doing it. So it's important that they're aware of the mechanics, the process, and the requirements. First of all, we need to understand whether somebody is eligible to transfer their properties into a limited company or not. So when you transfer properties into a limited company, there are two main hurdles. One is that there is capital gains tax to pay, and one there's stamp duty to pay. Capital gains tax is payable, and there are exemptions against capital gains tax and stamp duty, land tax. So capital gains tax exemption is available if the person who is transferring the properties into a limited company is spending at least 20 hours a week managing these properties. Okay, and for stamp duty, there are exemptions available if the property is owned through, or there is a partnership in place which is managing and owning the property. If you haven't got a partnership, then you've got to pay stamp duty. If you don't spend the 20 hours, then you've got to pay capital gains tax. So the best way to do it would be to say that you set up a partnership, you run the partnership for a couple of years, at least 2 years, I would say, maybe 3 years, and then incorporate. Now, for 20 hours a week to qualify as 20 hours a week, you would need at least a few properties. You can't say I have one buy-to-let property or two buy-to-let properties and I spend 20 hours a week. That wouldn't hold. That wouldn't stick, should we say. You've got to have at least quite a few properties to be able to demonstrate that you're spending 20 hours a week. And HMRC do check this. I'll cover this in a while. So the benefits of incorporation are that you've got no Section 24 restriction on limited companies. There's no capital gains tax on incorporation of the properties, assuming that you qualify for the exemptions. And there are stamp duty savings, but also you've got uplift in the base cost for capital gains tax purposes, which is quite useful. So essentially, if you transfer properties into a limited company, the base cost is uplifted. And if you then sell the properties to the limited company, there's no capital gains tax to pay. I'm assuming that there's no subsequent uplift in the price since you transfer them into a limited company. So this is quite a useful exemption. One second, let me see if I can put the light on. Hopefully you can see me better now. So there are quite a lot of benefits, and you can manage how much money you withdraw from the limited company. Drawbacks of incorporation: once transferred in, the properties are stuck in the limited company. They cannot be taken out. Okay, be aware of that. The government can change the rules, and corporation tax rate has been increased to 25%. So it's not as effective as it was before. There are other problems as well. So always seek specialist advice before proceeding, because you just want to make sure you're not making any mistakes. So HMRC inquiries and challenges. So essentially HMRC are regularly inquiring into incorporations. So if you say that, if you feel that you're spending 20 hours a week, make sure that you are, okay? And how you're spending your time, because HMRC will check that. If you have 2 properties or 3 properties and they're about to let AST, with ASD tenants. How are you spending 20 hours a week? Okay, if you have 3 HMOs, then that makes a difference. Then that's possible. But 3 buy-to-let single units, difficult to say. Who owns the properties? Was it you or the company or individual ownership? Who has the mortgage? How company or HMRC will check the documentation. There are quite a few processes to be followed correctly. If things haven't been done properly, then HMRC will charge, and the penalties for getting it wrong, the incorporation wrong, are severe and significant tax and penalties payable. So you need to be very careful, because I have seen incorporations were done by accountants who don't know how to do it, and they've messed it up really badly, and the clients have ended up paying about 500 to 600,000 pounds of tax. Okay, almost gone bankrupt. So be very, very careful. Can Churchill Tax help? Yes, of course we can. We are a leading tax advisory firm in the UK. I'm a chartered tax advisor. We have chartered tax advisors, tax barristers, ex-HMRC tax inspectors. So we are quite well known. We're quite well respected. And we are one of the very few firms in the UK that actually do end-to-end incorporations for clients. Quite a lot of client accountants and tax advisors outsource their incorporation work to us, especially to me. So yeah, do read our testimonials on our website and Google. We've got quite a lot of happy clients. So if you need some help with this, just give me a call. And here are my details. You've got my telephone number there and my email there. If you have any questions, do get in touch and I'll be more than happy to help. Thank you very much. Bye.